Hey, Happy New Year, everybody. Hope everybody enjoyed great holiday season. Spent some time with family and friends. That's what it's all about. But now we're into 2024 and it's time to take a look at the market. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. I enjoy coming on here to your Daily Five periodically just to share some of my thoughts and opinions about the market. And I've got some more today as we look into 2024. So again, welcome. This is the Wednesday, January 4th version of your Daily Five. And before we get started, I do want to start out. We got a couple of events coming up this week I want to make sure everybody's aware of. So if you are following us at earningsbeats.com, or if you go over to earningsbeats.com, both plural, earningsbeats.com, you can start a no-cost 30-day trial. We are having an event. It's an event open to any member. Don't have to be a paying member, but you do need to at least be a 30-day trial member. And we're going to talk a little bit about the January effect. I have a chart I'm going to show you a little bit later in this presentation to give you an idea of what I'm talking about. But the January effect is a kind of phenomena that takes place, has been taking place since 1950. And basically, it's that old Wall Street adage, as goes January, so goes the rest of the year. But I've got some numbers to back that up and support that. So that will be the event on Thursday at 4:30 p.m. Eastern Standard Time. Love to have you. If you're not currently a member at Earnings Beats, go over to earningsbeats.com. Make sure you start your 30-day no-cost trial. Also, I want to mention Saturday. This Saturday, January the 6th, we'll be beginning the Market Vision 2024 event at 9:30 a.m. Eastern Standard Time. It'll likely run until about 2:30 in the afternoon. So we're talking about a pretty lengthy conference. It's a virtual live online conference that's going to last about 5 hours or so. I've got Grayson Rose, who's the director of operations here at StockCharts.com. He'll be joining me for a presentation discussing some of the additions or some of the improvements in the Sharp Charts platform. So you want to make sure you mark your calendar for this event. There is a cost associated, although if you are a trial member at Earnings Beats, you will get 50% off. So simply going in and checking out our service for 30 days will give you 50% off on this Saturday conference. And all of our annual members, our full service annual members at Earnings Beats, this conference is free. So if you do sign up for the no-cost trial, you like our service, sign up for the annual before Saturday, and you'll have the event for free. But let's go ahead and get into my charts. So I do have 5 charts for you today, talking a little bit about market forecasting and some of the things that I'm looking at going into 2024. But first thing I want to do, I want to take you back, and I want you to honestly decide if attending this Market Vision 2024 event is worth your while. I'm going to take you back a year. 2023, at the very end of the 2023 Market Vision event, I laid out, and this is what I do at the end of each one of these conferences, I laid out what I thought was the path, the likely path, certainly based on the various risks at hand. This was the likely path that I saw in 2023. Remember, the end of 2022, we were down below 4,000. Looked like we were still in the midst of this bear market to the downside. I said, no, bear market's over. We're going higher. Well, on January the 6th, I laid this out. I said, okay, I think we're going to have a nice rally beginning of the year, make one more pullback, maybe back to 3,800. Then we would make a run into the summer, have one more pullback, and then the fourth quarter, I thought we would explode into the end of the year. My target was 4,700. So again, think back to the beginning of the year. I know we've had a lot, everyone, market's been going up now. Everybody seems to be turning a little bit much more bullish. But think where we were a year ago, because I'm telling you, I was out on a limb by myself, it seemed. There weren't too many folks talking about a bullish 2023. But this was the plan I laid out. This is what I thought we could do. And now I'm going to show you the chart of what we did overlaid on this chart. So here is what we actually did in 2023. So there was my early January strength, which we saw. There was my pullback to 3,800. I think we came back down to 3,850 or something. Then here was my run into the summer. There's the run into the summer. Here was the pullback into the early fall, and then a big strong rally into the end of the year to 4,700. We finished at 47. I believe we were at 47.69. So the market went up 24%, or the S&P 500 went up 24%. I predicted we'd go up 23%. I was off 1% at a period, by the way, when no one was talking bullishly. So what do I see for 2024? Well, that's going to be basically what I talk about on Saturday, but I'm going to give you a few hints, some of the things that I'm going to be watching for as we go throughout 2024. First thing I want to talk about is sentiment. And the best sentiment indicator for me, without any question, is the equity-only put-call ratio, because that is where you get your retail, your aggressive retail traders. And they're gamblers. And so their mindset, usually when they really all get on board that something's going to happen, it usually goes the other way. It's a great contrarian indicator. So on the top of this chart, this is a 15-year chart. On the top, I have the S&P 500. On the bottom, I have the 253-day moving average of the equity-only put-call ratio. So why am I looking at 253 days? Well, first, 253 trading days is the equivalent of 1 year. So I'm trying to get, I call this my, ocean liner kind of a signal. Doesn't give a lot of signals, but when it does, you need to pay attention. And essentially, when the market is going down in a bear market, going down, 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 sentiment keeps going down. Even after the market starts going up, sentiment keeps going down, 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 because folks don't believe. They don't believe that there's a reversal at hand. So what I have found in studying the market is that when you see this long-term 1 year moving average of the equity-only put-call ratio begin to turn, when it reverses and starts in the other direction, you need to look for a very significant reversal, most likely in the S&P 500. So anytime the market gets overly complacent, or let me turn this around. Anytime the market gets overly bearish, what happens to traders? When the market's going down, nobody wants to touch a call. Everybody wants to buy puts. Puts, puts, puts. So what does that do to the put-call ratio? Puts on the top of the fraction, calls is on the bottom of the fraction. The percentage of puts to calls moves much, much higher. And so throughout a bear market, if you will, you're going to see the equity-only put-call ratio go up, right? So when the market's going down, just like we were here in 2022, right here, see how we were going down? Look at this, started to turn back up. So the readings were very bullish, and then we started to turn up heading into 2022. So all the selling, all the fearful put buying and everything, as far as I was concerned, all the bears had, or all the bulls, I should say, had jumped in. Very few bears, because this put call ratio was coming down, meaning fewer puts, more calls. That's when the market was going up. And it got to an extreme. And it got to an extreme at the end of 2021. And so when it started to turn up, this was one of the big signals in 2022 where I said, you got to be careful, because now we're starting to see that equity only put call ratio move back and roll back to the upside. And so what we ended up seeing was that 2022 cyclical bear market and then the rally. And now we're up near this high, but now all the pessimism from all of this bearishness, all the bear market, cyclical bear market of 2022, and even through 2023, as the market was rebounding, do you see a big drop in the equity only put call ratio? Where were the bulls? Where were those option traders that thought the market was going to keep going higher? They weren't out there. They were still bearish. Nobody believed in this rally in 2023, which is nirvana when you've got signals that are all pointing higher, and then you've got sentiment on top of it where nobody believes in the rally. Perfect. That's what you want to see. But I want you to take a look at where we are now. Now what we've got here is a market that's going up, threatening a breakout, and Now, all of a sudden, we're starting to roll over. So all of this bearishness now finally looks like it's starting to get behind us and fall back. And now we've got the bulls that are just starting, it's just starting to roll over. We're just starting to see a little bit more calls versus puts. And I want you to look on this chart at what happens when this begins to roll over. 2009, remember that financial crisis? When all the fear started coming out of the market, what did the market do? In 2 years, equity only put call ratio dropped. S&P 500 went up 94% in 2 years. How about 2011, 2012? Fear picked up when it started to roll over, middle part of 2012, and headed lower during this entire 2-year period. S&P 500 went up 45%. Then we went through a period where market didn't do very well, and a lot of the fear was growing. A lot more equity puts being bought by retail traders. But what happened when this rolled over? When we started to get the breakout, people started to get, well, maybe I should be buying calls. Once that started to roll over, we made a 45% run in just over 2 years. Then we go through pretty much choppy sideways. Same thing with the equity only put call. And then we had the big rollover here that started this big decline from 2020 through 2021. That was after the pandemic. Remember, everybody got bullish. We made a massive run here during this period when we had rolled over. We went up another 53%, and that was in the course of maybe 15 months. And this whole move right up here, this whole thing was about 115% in 22 months. It was too much. Well, you can see all the bearishness picked up throughout these last 2 years. And we're still up there, but guess what? We're rolling over. And as we roll over, what does the market usually do? We roll over here, we roll over here, roll over here, we roll over here. Every time, market up, 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 and usually by a significant amount. As we've rolled over here and started moving lower, you can see what's already happened as we start 2024. So this is one signal. This isn't the signal. I have many, many signals, but this is one that certainly suggests that you'd be a little careful if you're on the bearish side. Another big part of what's going to happen in 2024 is how does the market react to the Fed, which had been extremely hawkish, now starting to become more dovish. 2024, we're expecting rate cuts as opposed to rate hikes. How is that going to play out? Now, I know there's a lot of folks that say, well, whenever rates, when the economy overheats, that's when the Fed wants to start hiking rates throughout that process, and eventually you'll get a recession from that. And then when you start lowering the rates, that's when you're worried about the economy, and you want to make sure that you're bringing the rates down to try and generate more growth. So there's a lot of folks that look at interest rates and think the market has to do one thing or the other, go up or down based on which way rates are going. I'm here to tell you it doesn't matter. I mean, it does matter. Interest rates are a big, important part of the stock market. However, you need to know why rates are going up and why they're going down. Is it economic activity? Is it inflation? Because sometimes they go up for both, either or. And the way you have to look at the market depends on why they're going up. Now, if we look back at inflation, this chart will show you the core CPI, the actual level of the core CPI over the last 50 years. Over these last 50 years, I believe there probably isn't more than maybe a 6 to 12 months where we've seen the core CPI go down. Only maybe half dozen or a dozen times. I didn't go back and add them up. Doesn't happen very often. In 2020, during the pandemic, remember, we shut things down. We had a government shut down the economy 30 days, right? Well, if there's no demand for 30 days, then what's going to happen to your CPI? It's going to go down. Prices are going to go lower. If you just all of a sudden stop with demand and you've got supply out there, but nobody's buying, prices are going to come down. That's what happens. Economics 101. So we had 3 months in a row where the core CPI dropped. And so then all of a sudden, the economy opens up again. And now everybody wants to get out. They just want to do something. They want to spend some money. And so that's what they did. So all of a sudden, demand accelerated what was normal. And what happened to supply? Well, you shut down factories for a month. What do you think is going to happen to supply? It dwindled. So now we come out of the pandemic and we got demand doing this and we got supply doing this. That's why inflation went up. Now, the Fed was wrong, and I'll be quite honest, I was wrong. I thought that it wasn't going to last as long as it did. I thought it was going to go up and come right back down. Well, it was a little stubborn. It stayed up. This is the annual rate of inflation in 2022. Went up to 6.5%, started pulling back, then we went back up one more time. And now look at where we are. Now we have fallen from 6.6, 6.7% down to 4%. And the Fed basically is announcing that the war against inflation has been won. That's the only reason they're talking about potentially lowering rates. You would not lower rates if you're worried about inflation. So we're going into an environment which I'm calling, this 2024 is, our title of our market vision event is Beyond the Fed. So I think the Fed's rate hiking is done. The question is, when do they start cutting? How much do they cut? And of course, why are they cutting? All of those things we'll be talking about at Market Vision 2024. You're not going to want to miss that. Last chart I have for you. This is the January effect. I told you we have an event coming up tomorrow. It starts at 4:30 p.m. Eastern, and it's available to any member of earningsbeats.com, including free trial members. So again, that 30-day trial right here. Start your 30-day no-cost trial. All you have to do is click on that button, get set up. You can come in tomorrow night and check this out. But in essence, what the January effect does, and what I consider it to do and to be, is it's a prognosticator to some extent, depending on how well we do in January or how poorly we do in January. The balance of the year tends to follow in certain directions. Last 2 years, absolutely perfect. They could have both been poster child of what you would look for with the January effect. January of 2022, we saw a horrible January, and it was so bad that it fit into quadrant 4, which tells us it's among the 25% worst Januaries since 1950. That's how far back my study goes. So January was horrible, and in quadrant 4 tells us that we shouldn't be expecting much from the balance of the year. When you have a down January, you tend to not do very well over the balance of the year. Not every year. It's not guaranteed, but it's giving us a signal, and I think it's worth respecting. Move on to 2023 and look at what we got. We got the exact opposite. We had a massive January. Not only did we have a massive January, I wrote a couple articles right at the beginning of January, and I said, we're going to go screaming higher. And literally right after I wrote that article, I think it was on January 5th or 6th, it might have been that weekend that I did Market Vision 2023. But literally that next day or day or two later, just took off and never really looked back. Solid January. Then we had the pullback. But that solid January put us in, it was the 9th best January since 1950, put us in quadrant 1. And in quadrant 1, this is where we tend to see the best rallies over the rest of the year. And so what did we do? We went up. We had another great fourth quarter and finished strong for 2023. So January is going to give us another signal. Maybe a good one, maybe a bad one, maybe a neutral one. And it may just be wrong. It's not always right. So it might give us the wrong signal. But again, with Market Vision 2024, what I try to do is go through all of my various signals, put all the puzzle pieces together, and come up with a most likely pattern, just like I did last year, of what I thought would happen, which turned out that it did. It happened almost exactly as predicted. Saturday, I'm going to tell you what I think about 2024. So again, go over to earningsbeats.com. Make sure you sign up for that no-cost trial. Come join me tomorrow evening at 4:30 p.m. Eastern. That's Thursday, January the 5th. Actually, Thursday, January 4th. I think I announced today was January 4th, but it's actually January 3rd. Still trying to get caught up from all these holidays. But anyway, tomorrow, Thursday, January 4th, make sure you are a trial member. You can come in and join me for that event. I think it's going to be an eye opener for you if you haven't already seen one of these webinars that we've done. And then on Saturday, Market Vision 2024, click on that link and it'll bring you to our page here. Talks about what is going to happen. Here's the event agenda. Here are some of the calls from the last 4 Market Vision events. They've been absolutely spectacular. And I'm looking to make it 5 years in a row on Saturday. So with that, again, it was a pleasure joining you here today on Your Daily 5. I want to wish everybody a happy new year. I hope 2024 is happy, healthy, and financially prosperous for all. Take care, everybody. Happy trading.